So a common strategy in retirement planning is called the Rule of 100, and it states that individuals should hold a percentage of stocks equal to 100 minus their age. So for example, if you are age 60, 40% of the portfolio should be equities and 60% should be held in something conservative like other fixed rate investments, bonds, treasuries, CDs, or something like that. However, many of these investments are paying next to nothing right now. So to compensate, many investors' equity exposure is too high for their age. Now there are alternatives in the form of fixed indexed annuities. And here to talk about these products is my guest Gaines DuVall with DuVall Financial Group. So how does a fixed indexed annuity work, Gaines?
Yeah, so in very simple terms, a fixed indexed annuity allows the consumer who normally takes all the risk themselves and transfers the risk to an insurance company. Insurance company is going to guarantee that their money never goes down and that when certain indexes and strategies go up, their money goes up. So think of it like walking up a step of stairs or a ladder, a flight of stairs. You're going to go up when the market goes up. When the market goes down, you're going to stay completely flat.
So with this strategy, talk about the fees involved.
Yeah, fees, wow. That's a long conversation to have. How do fees affect your portfolio? Well, in most fixed indexed annuities, if there is a fee that's associated with it, it's generally going to be very small, lower than you would maybe get charged if you were investing in alternative strategies. But a lot of the fixed indexed annuities that we use, essentially for accumulation for our clients, have absolutely zero fee. So literally, when the market goes down, you get a 0% return in that year.
Gaines, if somebody right now watching was considering purchasing a fixed indexed annuity, what question should they be asking?
Yeah, so independent firms like us have access to over 500 fixed indexed annuities. So it's not as simple as this is the best one for everybody out there. So as the consumer, you need to have a good relationship with your financial consultant so you can have this conversation here. And here's what you need to ask. You need to ask, what is the financial stability of the insurance company that my fixed indexed annuity is going to be with? That's very, very important, often gets overlooked. Number two, what do the past index crediting strategies look like versus the current? So what we'll see sometimes is some fixed indexed annuities will have a really big buy-in rate, and then we'll see those rates go down pretty quickly. So you want to make sure that you're picking an annuity that when we look at the past, those companies have honored their commitment and got you the best returns that you can get. And lastly, and maybe most importantly, when considering an annuity, the question becomes, when do I want to access my money? A fixed indexed annuity isn't designed for a place for you to park money and a year later pull it all out. It's going to be a long-term, generally a long-term play of 10 years or more. So you need to ask yourself, talk to your financial consultant about how long am I going to keep my money in there until I actually start accessing it.
My guest has been Gaines DuVall with DuVall Financial Group. You're watching Retirement News Online.